All right, if you trade the SPX, you know that your edge is everything. Today, we're going to break down something that goes way beyond just looking at a price chart. We're talking about the volatility smirk. And look, this isn't some dusty academic theory. This is a real, live tool that shows you the market psychology, and it can give you a serious, actionable edge.
So, let's just start with a big question. Is that classic options model you learned about, the foundation of so much financial theory, is it actually lying to you? Well, the short answer is, yeah, kinda. Because it's based on a perfect, clean version of the market that, let's be honest, just doesn't exist in the real world.
Okay, check this out. That textbook model, Black-Scholes, it assumes two things that are just not true. First, it pretends volatility is a flat line, the same for every single strike price. Second, it assumes price moves follow this perfect, neat little bell curve. But anyone who's been in the trenches knows that's not how it works. In reality, volatility has a shape, a curve. And more importantly, those wild, crazy moves, the fat tail events, they happen way more often than the model gives them credit for. And right there, in that gap between the neat theory and the messy reality, that's where we find our edge.
So, here's the game plan. We're going to look at why that foundation is flawed, then we'll decode the volatility smirk itself. We'll learn how to read it like a fear gauge, how to turn its shape into actual trades, and finally, we'll see what it was telling us during some of the biggest market crashes in history.
So first up, let's really hammer home why that standard model is the wrong place to start. It gives you a map to a place that doesn't exist. To trade effectively, you need a map of the world as it actually is.
And the key that unlocks that real-world map is implied volatility, or IV. Now, this is crucial. IV isn't about what happened in the past. It's the market's collective, real-time forecast of what's about to happen. And we don't just guess it. We pull it directly from the actual prices people are paying for options right now. It's the market's own prediction.
And that brings us to a huge distinction, IV versus historical volatility. Think about it this way. Historical volatility is like trying to drive by only looking in your rearview mirror. It tells you where you've been, it's a lagging indicator. IV, on the other hand, is forward-looking. It's like your car's GPS, showing you the traffic up ahead. It already has all the past data baked in, plus the market's current feelings and expectations. That's why we focus on IV. It's the superior predictor.
So what happens when we take this forward-looking IV and plot it across all the different strike prices? Well, you get a picture that literally unmasks the market's true face. And this is where we finally meet the smirk. But first, real quick, let's talk about its cousin, the volatility smile. In some markets, like currencies, you see this nice symmetrical U-shape. IV is lowest right at the current price, and it rises equally on both sides for puts and calls. It suggests the market thinks a big move up is just as likely as a big move down. Very balanced.
But in the SPX, oh no, we don't get a friendly smile, we get a smirk. And just look at that asymmetry. The implied volatility for out-of-the-money puts, the insurance against a crash, is way higher than for out-of-the-money calls. The market isn't balanced at all. It's constantly pricing in a much higher chance of a sudden drop than a sudden rally. And that one picture tells us basically everything we need to know about the market's mindset.
So, why does this smirk exist? It really boils down to two things. First, there's a collective market trauma called crashophobia. Ever since the big crash in 1987, huge funds and institutions are always terrified of another one. So they constantly buy out-of-the-money puts as portfolio insurance. That relentless demand pushes up the price of those puts, which means it pushes up their IV. The second driver is the leverage effect. Think about it. When a company's stock price falls, its debt doesn't shrink. That debt now looks bigger and scarier compared to its equity value, making the whole enterprise riskier and more volatile. Both of these forces work together to pump up the value of puts.
Okay, so this is where it gets really cool. We can use this smirk as more than just a weird observation. We can actually use it as a real-time fear gauge. We can put a number on market sentiment just by reading its shape.
And it's super intuitive. When that smirk gets really steep, it means the demand for those downside puts is through the roof. IV is jacked. You can almost feel the anxiety in the air. This is a crystal clear signal of high fear. Traders are willing to pay a massive premium to protect themselves.
And of course, the opposite is true. When the smirk starts to flatten out, it's a sign of complacency. The fear of a crash is fading. The price for that downside protection is dropping. It could be signaling a more bullish or just a more stable market where people aren't looking over their shoulders all the time.
Now, to get past just eyeballing the chart, The pros use a specific metric called the risk reversal. It sounds a little technical, but the idea is actually super simple. It just measures the exact difference in IV between an out-of-the-money put and an out-of-the-money call at the same probability level. It gives us one solid number to track the Smirk steepness.
So here's how it works in practice. You might see a value of, say, -25. What does that mean? It just means a 25 delta put, an option with about a 25% chance of paying off, has an implied volatility that's 25 points higher than the 25 delta call. If that number gets more negative, like -30 or -35, you know fear is rising. If it moves up towards 0, you know complacency is setting in. It's just a clean, simple number that acts as a snapshot of market fear.
Okay, so we can read the fear, we can quantify it. Now for the most important part, how do we actually trade it? Let's turn this analysis into some concrete strategies. This is where the rubber meets the road. If you're bearish and you see that Smirk getting steeper, you know puts are getting super expensive. So instead of just buying one, you can use a bear put spread. You buy the put you want, but you help pay for it by selling a cheaper put further out of the money. It's a way to get your bearish exposure without paying that insane fear premium. Now, what if you're bullish and the Smirk is flattening? This is perfect for a bullish risk reversal. You can sell one of those still pretty expensive puts that everyone's buying out of habit, and you use the cash you collect to buy a call. You are literally selling the market's fear to finance your greed. It's a beautiful thing. And to really see how powerful this is, let's look at how the Smirk behaved in the wild during two of the biggest market meltdowns in recent memory. This is where theory gets put to the ultimate test.
Man, remember March 2020? The defining feature was speed. The market went from an all-time high to a correction in just 6 days. It was breathtaking. And as it happened, the Smirk steepened like crazy, almost going vertical. It was a textbook, pure explosion of crashophobia. The demand for downside protection was infinite, and the Smirk was a perfect, real-time picture of that absolute panic.
But 2008 was different. It wasn't just panic. It was something deeper, something heavier. Researchers who went back and looked at the data from that crisis found something they called an anomalous IV frown. And this quote is the key. It signaled a certainty that the downturn would persist. It wasn't a question anymore. So what's the difference? Let's put it this way. The 2020 Smirk was a scream of acute fear. It was a high perceived risk of a crash. People were terrified of what might happen. But the 2008 frown signaled something else. Bearish certainty. It wasn't just fear. It was a deep, settled conviction that the decline was here to stay. The market had given up hope of a rally. It was a much, much darker signal. Okay, so let's boil this all down. What do you need to remember? First, the volatility Smirk is not a mistake in a model. It's a real-time map of market fear. Second, it gives you a forward-looking edge that you just can't get from looking at old price data. Third, you can put a number on it with things like the risk reversal and use it to build actual trades. And finally, the little details matter. The difference between a Smirk and a frown can signal totally different kinds of market stress, from a sudden panic to a deep, grinding despair. At the end of the day, the Smirk is just the market's public diary of fear, and it's written in the language of options prices. It's been hiding there in plain sight this whole time. Now you know how to read it, so the only question left is, what is it telling you today?